So, shall we get to some portfolios, Steve? What have you been doing in the last, 3 months or so in what we call Q2?
Yeah, so not much, Steve, but a busy sort of finish to my quarter. So um, relatively quiet, and then as the 6 month review came to point, I started to think about maybe making some changes and trying to just freshen the portfolio up a little bit, sort of try and get rid of companies that I began to lose a little bit of faith in, and move into companies that you know, or further back companies that I think are mispriced. So just thinking back to January, which is it was already covered in the last review, but it's just to quickly wash over. I got off to a roaring start in January, and then spent pretty much all of February and March, like most people, giving it all back. When tariff time hit, um, I think due to the way I'm weighted with some decent chunks in the UK and the EU, there's been a little bit of uncertainty in those areas. My recovery has been a little bit more sluggish in comparison to the S&P, which has moved the world indexes along a little bit more. So yeah, for the last 3 months, I'm up about 1%, but year to date, I'm still down about 2.9%. Genuinely, any good periods that I've had have been followed by bad. And normally we've recorded the show and I've said to Steve, hey, I'm doing pretty well. I'm up 2.2% on the week, and we record it on Thursday. And then by the Friday night, it's like, oh crap, it's actually 1.1% or something like that. Or so. So yes, that's been happening to me a fair bit that I've noticed. And I said to you, Steve, the other day that I'm thinking I'm getting the malaise that you get for investing when you get periods like this, where you think like, why am I bothering wasting all of this time? And you think I could just slam this in an index, and that would be that. But hey, look, I know I've been doing this long enough that I know you have to push through these periods. You just have periods like this where the companies that you've weighted money to just don't perform the way you expect them to, and it's just one of those things. I think sometimes you've got to sit tight and see how you go. In terms of position, Steve, I'm down to 26, and by size, it's pretty much the A letter show. But I'll just quickly read through them and see what you think. But it's Amazon, ASML, Adyen, Alphabet, Walter Disney, Nintendo, LVMH, Prologis, Four Corners Property Trust, Bloomsbury, Mid America, Alexandria, and then shooting up the list, Judges Scientific ahead of Wise, Vistry, Ashtead Technology, Renishaw, Airbnb, Sartorius, VAT Group, Axelis, Progeny, Toast, Zender Group, Technoglass, and Transmedics. That's the 26. So there'll be some new ones in there, but I'll tell you which ones they are in a little bit. Very concentrated at the top now, Steve. It was 38% at the top. It's now actually 42.5% in the top five. So it's about as concentrated as I've ever been. In the quarter, I've added to a number of stocks, but Alexandria, Ashtead Technology, Axelis, Bloomsbury, Judges, LVMH, Prologis, Renishaw, Sartorius, VAT, and Vistry. I've had the vast majority of any capital that I've added to this portfolio or freed up by selling. The new ones that you may not have seen last time are Technoglass and Toast. Both of them are new to the portfolio, and Technoglass, I will promise I will cover that at some point when we get a little bit of free space. Toast, I think Steve and I have covered a number of times at length, and we think it's a pretty fantastic outfit. So in terms of what's missing, Enphase has gone completely. I think I said that on the show. Euronext went this week with Novo Nordisk. Euronext had been a fantastic performer for me and was up about 35% year to date, up about 85% in the portfolio or something like that. Felt like it had probably ran its course. Novo Nordisk, the opposite problem with that. I think they've hit a number of issues recently, and I think their biggest issue is that Eli Lilly's drug is simply better. And when you actually look at the numbers in the cold hard facts, it's 50% better and is marketed as such. So when it comes to the choice of people buying this medicine or trying to get this medicine, you're going to get asked the question, would you like to lose 22% of your body weight, or would you like to lose 15? And the prices are roughly the same. And I think you'd be a fool to pick one over the other because the side effects are even similar. So it is an inferior product, and whilst there was a shortage, I thought there was an opportunity for Novo Nordisk to do some squeezing out. That has not happened. At the beginning of the quarter, Steve, I sold Southern Copper and I sold Steel Dynamics. That was when the tariffs hit. And I thought that nearshoring was what Trump would do, but he actually switched on very nearshoring. And that was an issue for both of these because Steel Dynamics was set up for nearshoring, but not very nearshoring. It had plants outside of America that I thought would benefit, and then that completely changed that thesis, so that had to go. And Southern Copper, Steve and I have got pretty much a long-term bull case on copper, but that stock had run up a few 100%, and I just thought there was better opportunities out there. In terms of my top five, Steve, so Transmedics is up about 104% this year. Nintendo up about 58.5% this year, so that's a double bagger for me now. Zenda is up about 42 and a bit percent. Progeny remains 22% up, which it was last time we recorded, and Toast is up about 13.5% on the year, but I didn't buy it then. I'm actually up about 30% on it, so that's going pretty well. Bottom five, Renishaw down 14.5%. I haven't caught all of that. I've only caught about 5% of that. The next four, I've caught every single penny of it, though. Ashted down 22.5%, Bloomsbury down 24%, Alexandria down 24%, LVMH down about 31.5%. So pretty big falls, really, from four companies there, Steve, that a couple of years ago you wouldn't have imagined would be, three of them you wouldn't imagine would have been falling at that kind of rate. I've got about 2.5k in cash at the moment. I'm still trying to be patient. There are opportunities out there, but I'm still weighing up adding company, something like Thermo Fisher in that I've done the work on. It feels like it's probably a good addition, but also I'm looking at the opportunities within my own portfolio where I think there's still quite a few. So yeah, I need to have a think about that. So yes, look, benchmark for us, for me especially, is VWRP, and that's what I would buy if I wasn't buying individual stocks. So I checked it out on Google when I wrote this on Thursday night. It'd probably be a little bit better than this now, but it was down 1.78% year to date. So I'm a percentage point behind on what was essentially a good week this week. I think it's all to play for, Steve, in terms of what I would do. But yeah, that's where I am at the moment, and yeah, I think it's going relatively okay.
I think it is going relatively okay. Some of those big fallers that you mentioned look to me like, a couple of them in particular stand out to me as sort of short-term fallers. LVMH stands out as a short-term faller because I sort of back the business, but I don't have a particular reason for thinking that's going to turn soon rather than it will turn because it's very, very good. The two that jump out at me are Renishaw and Ashted. Renishaw is one that's heavily exposed to semiconductors, which have been in a bit of a kind of coming down cycle since COVID, but that's starting to pick up again. And you saw Spectris, a company that we have talked about very in passing over the last about a couple of weeks ago now, getting acquired most likely for what I think is actually a pretty smart acquisition price, and sort of having me wondering why I didn't look closer at that. I do remember why I didn't, but we won't talk about that for too much. But Spectris and Renishaw are very similar types of businesses. They're not the same, but they do similar kind of things. And you saw Renishaw's share price push a little bit as a result. But I sort of think that cycle might be turning there for Renishaw. And the other one that sort of sticks out to me as a potential near-term assister here is Ashted. Ashted Tech, that is, right, in your case, the underwater Ashted. I'm starting to hear various things about the UK, in particular with its energy policy, starting to think we need to do something to try and bring down people's bills. And that thing we need to do is maybe start thinking about energy generation in the North Sea again, whether that's to do with drilling oil out or offshore wind. And there's sort of specialists in offshore wind, but their oil stuff has mostly been recently stopping things up, from what I understand of it. But I sort of think there might be decent things coming for Ashted here, and I like that business very much. It's clearly in a bit of a down cycle and has been coming off, but I'm quite taken there. The other one I think that I always constantly think of at the moment, and I think you may have mentioned it on your list of add tos, here is Alexandria, which is a case of where I don't see anything materially changing about that business recently. in terms of share price is down quite a bit from when we certainly first started talking about it. It's not a great time to be a big pharma company in the States. They're talking about bans on kind of direct to consumer advertising and so on, but I'm not necessarily sure that's the end of the world for them. Not an awful lot has changed, I think, for Alexandria, and rates haven't gone anywhere in the US either. It's not like they're going higher particularly yet. That dividend yield is now up over, I think it's well over 7% here if you don't factor in a withholding tax, and then you knock a bit off that because you probably do need to factor in a withholding tax, but that's unusually high for those guys. So I mean, my sense with your 2.5K in cash that you thought you had is I kind of think there are opportunities within this portfolio, and there are certainly in the ones that I've just mentioned anyway, and potentially in some others as well. I'm constantly reminding myself that stuff doesn't have to be down for it to be good value here. You think though you might lean Thermo Fisher is your instinct here?
Well, I'm not saying that at all. I was just saying I thought about adding it in, and I'm thinking that, like you, there are probably better ideas within the portfolio itself, probably trading at um, uh, better multiples as well, Steve. So one of the things that was about Spectris that caught my eye was that KKR came in with a late bid and got snubbed in favour of, I think it was Advent, Steve. I want to go with Advent as the people who eventually won the got recommended in the bid. But KKR are evidently on the lookout for a company of that kind of ilk, and the sort of like next one down the line is Renishaw, who are willing sellers as well. I don't know if that's um, if people knew that, but the people in charge of Renishaw, the people who own the most amount of stock, are actually on the lookout for kind of getting to the point of potentially selling and enjoying the money they are getting on. With Alexandria, Steve, I'm always sort of drawn to this. Their top 20 tenants at their in their buildings is incredible. I'll just allow me to read this list. This is obviously in the biggest to smallest, but Eli Lilly, Moderna, Bristol Myers Squibb, Takeda, Roche, Illumina, Alphabet, 270, the United States government, Cloud Software Group, Novartis, Uber Technologies, AstraZeneca, Boston Children's Hospital, the Regents of University of California, Sanofi, Merck & Co., New York University, Charles River Laboratories, and the Massachusetts Institute of Technology. I mean, in that list, Steve, there's not a massive amount of things that you would go down and say, look, there's problems here, there's problems at that one, there's problems at this one. Yes, Illumina's not as strong as it was, and Moderna's probably not as strong as it was. But outside of that list, it's a pretty good list of companies, and that makes up about 35.5% of their revenue. There isn't a single company on the list that doesn't have an investment grade rating out of the ones that are rated. There's a couple of them that are private companies, so or universities or things like that. So don't have a proper Moody's rating as such. But yeah, there's some pretty amazing companies in there. They've got some pretty amazing property locations, and I just think it looks like a really good company, and I have shoveled a lot of money into this. If it was to be flat for me, it would be probably in my top top 6 positions, but it isn't flat, and it's just like sometimes you feel like you're throwing money down a big hole, and it's difficult with things like Alexandria because it is consistent in its in its going down. And I don't know. I don't know where I sit with that yet. Because I was also drawn to Rexford at one point, which is also in the kind of Prologis kind of space, but a bit more sort of generalized or tighter located. And there's loads to think about in that area, Steve, because none of the REITs that are actual kind of location based REITs are doing that well. But the ones in hospital space are doing especially badly, Steve. So yeah, plenty of opportunity in the portfolio, I think, and that's why Thermo Fisher isn't in already. I think eventually I'll spend this money elsewhere.
I know that feeling about shoveling money into a ever deepening hole. It feels pretty good at first, right? I mean, it feels like I bought this thing not that long ago. Now it's cheaper. I can buy more of it. I can put money into this thing. I'm getting get a better return. Assume it doesn't go to zero. I'll do better now than I would have done buying it at a higher price. It's not going oversized in my portfolio because the damn thing keeps going down. So it's actually not becoming an outsized position. All I'm doing is adding it back to where it was, or maybe a bit more. But nonetheless, it's not kind of. I wanted to get a lot into this, and I'm getting a lot into it. And then after it's been doing that for sort of about 6 months or so, and you're down about 30% on the thing, you just start to wonder. Well, hang on. Am I flinging good money after bad here? I don't think I am, but I do get that feeling. At least with Alexandria, you get a dividend of a sort, which isn't something we typically say on this show because we tend to think you ought to be doing better than just aiming at acquiring a dividend. And if all you look at is the dividend, you're sort of missing most of what investing tends to be about. But yeah, I definitely hear that feeling on chucking money down a hole that keeps emptying itself out again.
My worry is what happens if that dividend then gets cut. If they take this as an opportunity to say, look, maybe we should trim that dividend back, save some money. Maybe they, maybe second guessing what investors want, kind of thing. And that would be my worry. I mean, there's not really much a chance of worse. That's famous last words, isn't it? But I haven't seen anything in their FFO readings that come through that make me think this is an imminent issue. But they are in the process of slimming down their specialist buildings. So from trying to focus on higher quality in these clusters rather than these lower, they had a little bit of lower quality and higher quality. And these are very specialist buildings. They're hard to sell on. They come with high ceilings and expensive HVAC systems, and they're not something that you can just repurpose into an office. They are pretty specific in what they were built for. So yes, you don't always get the best price when you sell them off, especially if they're a low quality building that another REIT doesn't want. It can be tricky for them. But look, these guys have navigated markets like this before. We've had biotech boom and biotech bust, and we're just going through a period at the moment where there's at government level a malaise for biotechs, and that's coming through into Alexandria. I don't think any of the bear cases I've read about them have very much merit, but the thing keeps going down, Steve. So maybe I'm missing something.
Yeah, I just don't see it. There are REITs, it's really hard for them to cut their dividend. Something has to go wrong with their business, I think, for their dividend to get cut. And I'm not sure I really see anything going that wrong with their dividend. They're not replaceable. I don't see they can be innovated away, put it that way. There's no way these companies can do R&D without pretty specialist labs. They might find themselves doing less of it, but I think that also seems relatively unlikely. And one of the last things to go is going to be paying their rent on their contracts here. Even if they invest less into R&D, it doesn't matter. They still got to pay the kind of rent on that. The downside to these things, as we talked about before, is they're never going to overpay their rent, particularly. So if they do really well, which they're currently not, you won't particularly benefit from the upside. But you can get it at a good enough price, you might well think you're kind of okay. It reminds me a little bit of Supermarket Income REIT over this side, where everything about that company is a double-edged sword, basically. They have a huge yield. They have contracts with every big supermarket. They're linked to inflation, which means that they will go up, and they won't go up much. So you need to make sure that what you're getting in terms of a starting point is all right, because you're not going to see huge amounts of growth from this, I think, unless they do something quite slick, and that involves risk. But yeah, I think I kind of vaguely, tentatively interested in Alexandria for my own portfolio here. So yeah, I've got an eye on that one too. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.